Right now, Seanergy Maritime Holdings Corp is trading at exactly $9.48, up 24 cents on the day, which translates to a solid 2.63% gain in today's session alone. While a movement of roughly 2.5% might look like standard market noise if you are watching high-beta tech names like Nvidia stock or tracking the intraday swings of Tesla stock, this specific upward tick in the shipping sector represents something far more significant than just a random fluctuation. Most investors scrolling through their Robinhood app or checking their positions on SoFi Invest will gloss over a ticker like SHIP because they are conditioned to look for the next massive tech breakout. But what is happening right now with Seanergy is a direct reflection of a tightening in the global supply chain that the broader market is drastically underestimating. The expectation for dry bulk shipping companies, especially those dealing in the massive Capesize vessels, is that they are slow, antiquated businesses that only move when the global economy is booming. The common belief is that if China's property sector is struggling, you should stay miles away from iron ore carriers. That is the expectation. The reality, however, is that Seanergy is currently decoupling from that macro pessimism because the supply of vessels is so dangerously low that even a minor uptick in demand is forcing charter rates higher, creating a profit wedge that this pure-play company is perfectly positioned to exploit. When you look at a company like Seanergy, you are looking at what is known as a pure-play Capesize operator. Unlike other shipping giants that might mix in smaller vessels like Supramaxes or Panamaxes, which is like a portfolio manager hedging their bets, Seanergy goes all in on the big ships. These are massive vessels, typically around 180,000 deadweight tons, designed almost exclusively to haul iron ore and coal across long distances, primarily from Brazil and Australia into China. The price action we are seeing today, that push to $9.48, is likely a reaction to a firming in the Baltic Capesize Index, which acts as the heartbeat for this stock's revenue. If you are sitting at home using Fidelity investment research tools or scanning charts on your Interactive Brokers trading platform, you might notice that the correlation between Seanergy and the broader industrial sector is shifting. Usually, when fears of a recession loom, shipping stocks tank. But recently, despite economic headwinds, the rates companies can charge for these ships are holding up surprisingly well. This creates a tension between the shipping is dead narrative and the cash flow is king reality. Seanergy recently reported third-quarter earnings that essentially smashed expectations, posting earnings per share of 61 cents against a backdrop where many analysts were expecting far less. This is the classic discrepancy that savvy investors look for, a stock priced for disaster while the underlying business is printing cash. Let's talk about the mechanics of this trade because it is different from buying Apple stock or putting money into Schwab Intelligent portfolios, where the goal is steady passive compounding. Investing in Seanergy is an active, aggressive play on commodity volatility. The company generated net revenue of $47 million in the third quarter, a 6% increase year over year. Now, a 6% revenue jump doesn't sound explosive if you are used to crypto returns on your Robinhood crypto wallet, but in the mature capital-intensive world of maritime logistics, growing revenue while selling off older assets is a sign of extreme operational discipline. They recently sold the MV Genius ship, a move that brought in over $21 million and generated a net cash surplus of $12 million after repaying the debt attached to it. This is crucial because it signals that management is not just hoarding steel, they're actively managing their equity. For years, the knock on Seanergy was that it was a dilution machine, a company that would constantly issue new shares to keep the lights on. The reality shifting into late 2025 is that the capital structure has cleaned up significantly. The expiration of their Class E warrants is a massive technical development that many retail investors using simple investing sites might miss. When warrants expire, it removes the overhang or the potential for a flood of new shares to hit the market and suppress the price. With that overhang gone, the stock has a much clearer path to react to fundamental improvements, which is partly why we are seeing this resilience at the $9.48 level today. The dry bulk market is driven by a very simple yet brutal equation, the time charter equivalent, or TCE. This is effectively the daily revenue a ship earns after subtracting voyage expenses like fuel and port fees. In the third quarter, Seanergy's fleet earned a daily TCE of roughly $23,476. To put that in perspective, their daily operating expenses, what it costs to crew, insure, and maintain the ship, are a fraction of that. The spread between the two is pure profit capability. This is where the leverage lies. If the daily rate for a Capesize vessel jumps from $20,000 to $30,000, most of that extra $10,000 flows straight to the bottom line because the cost to run the ship hasn't changed. This high operational leverage is why Seanergy is more volatile than a standard dividend stock you might find in your Fidelity mutual funds or Fidelity ETFs. It is also why traders who use interactive broker stock trading tools love this ticker. The swings are predictable if you track the underlying commodity flows. The current market environment is fascinating because despite the noise about a global slowdown, the raw volume of iron ore moving into China hasn't collapsed. China is pivoting from building apartments to building high-tech infrastructure and electric vehicles, both of which are steel-intensive. This means the demand for the specific cargo Seanergy hauls is stickier than the headline news suggests. If you are an individual investor managing your own capital through an individual brokerage account, you need to understand the China factor deeply. About 40% of all dry bulk cargo is iron ore, and the vast majority of that goes to China. When you see news about Beijing announcing stimulus packages, you often see Seanergy's stock price twitch instantly. This is because the market is trying to front-run the physical demand. However, there is a delay. Stimulus announced today takes 6 months to turn into steel orders, which takes another month to turn into shipping contracts. We are currently in that lag period. The expectation is that the stimulus will fail. The reality is that even a moderate success in stabilizing the Chinese economy creates a massive floor for shipping rates. Furthermore, there is a supply shock coming that almost nobody is talking about on Main Street financial news. The global shipyard order book for Capesize vessels is at historical lows. You can't just 3D print a massive ship, it takes years to build. Because shipyards are full of orders for container ships and LNG carriers, liquefied natural gas, there are very few slots left to build dry bulk carriers. This means that for the next 2 to 3 years, the supply of ships is effectively capped. If demand grows by even 1 or 2% and supply is flat or shrinking due to scrapping older vessels, rates have to go up. This is the long-term bull case that supports the stock. It is also important to contrast the investment experience of holding Seanergy versus using a robo-advisor like SoFi Robo-Advisor or relying on broad market baskets. When you use Schwab Intelligent Portfolios, you are protected from idiosyncratic risk, the risk that one specific company blows up. With Seanergy, you are taking on specific risks, the risk that a vessel breaks down, the risk of bunker fuel prices spiking, or the risk of geopolitical tensions closing a trade route. For instance, the recent disruptions in major canals have forced ships to take longer routes. While this sounds bad for efficiency, it's actually bullish for shipping stocks. A longer route means the ship is tied up for more days, which removes supply from the market and drives up daily rates. This inefficiency is a profit driver. Seanergy's fleet, which consists of roughly 17 to 20 vessels depending on recent transactions, is positioned to capture this. Their fleet age is approximately 14 years. This is older than some competitors like Golden Ocean, but in a high-rate environment, a 14-year-old ship earns the same money for moving a ton of ore as a brand new ship. But the older ship has a much lower break-even cost because it's cheaper to buy and finance. This strategy of buying mid-life assets allows Seanergy to generate high cash-on-cash returns, provided they manage the maintenance costs effectively. If you're sitting there with your Fidelity mobile app open, looking at the dividend yield, you will notice another massive factor: the income. Seanergy recently declared a cash dividend of 13 cents per share. For a stock trading under $10, that's a significant yield annualized. This marks a shift from a company that was purely a speculative trading vehicle to one that is returning capital to shareholders. This transition is critical for attracting a different class of investors, those who use Fidelity Wealth Management or look for income in their Fidelity IRAs. It signals that the board of directors believes the cash flow is sustainable enough to hand it back to you rather than hoarding it for an emergency. This stands in stark contrast to the burn rate mentality of many small-cap tech stocks. However, you must remain vigilant. High yields in shipping can be fleeting. Unlike a utility company where the dividend is almost guaranteed, shipping dividends are variable. They go up when rates are high and can vanish when rates crash. That's the trade-off. You're getting paid